1031 exchanges are one of the most important tools real estate investors can use to build wealth. It's potentially going to be eliminated, which would be devastating for real estate investors. But until it is, it continues to be an invaluable tool. For those not familiar with it or the various options available, here's a basic condensed version. For more details, contact your attorney and make sure they know how to facilitate a 1031 exchange, because any mistakes could invalidate the exchange and cost you a substantial amount of money. It's also imperative that you use a 1031 intermediary. They'll help you follow the IRS rules and guide you through the process. Essentially, 1031 exchanges are selling one investment property and buying another of higher value within a specific amount of time. Specifically, the selling of one property and the acquisition of another must be completed within 180 days in order to defer the capital gains tax as well as the depreciation recapture tax. The property being acquired must be like kind, which means that it must be anything except a single-family house for you to live in. In other words, you can sell a farm and buy an office building, sell a multifamily property and buy a self-storage property, or even sell an investment single-family rental house and buy a retail strip. The challenge with selling multiple single-family houses is that unless you sell all of them at one time, you have a separate timeline to acquire another property for each one. The timeline is as follows. From the date you close on the sale of a property, you have 45 days to identify up to 3 properties and close on one of them with a value that exceeds the value of the selling property within 135 more days. It's imperative that you never take receipt of the funds from the close of the sale, otherwise it invalidates the exchange. Rather, the 1031 intermediary will hold the funds for you. This is known as the 3-property rule and is the method most commonly used. There are additional options that can be used. For example, there's the 95% rule, in which the seller can identify more than 3 properties with a total value which exceeds 200% of the value of the property sold, but only if the seller acquires at least 95% of the value of the properties identified. There's also the 200% rule, which allows an unlimited number of properties to be identified, as long as the total fair market value of the properties identified doesn't exceed 200% of the value of the property sold. There are further details with respect to these 3 methods, which need to be discussed in further depth to accurately facilitate a 1031 exchange. This is only meant to be a basic description of these 3 methods.